3, 2, 1. Welcome to the show.
Looks like we're on.
I think we're on.
I hope we're on.
Somebody messaged, I don't remember where I saw it. It was on YouTube or somewhere, but they said they couldn't hear us very well, which struck me kind of off, because I think I do it. Actually, I do it a little louder.
It sounds loud to me. Yeah.
Well, that's because our volume in our ears are loud. But like when I go back and listen to the video, it sometimes sounds obnoxiously loud, but I make sure that it's loud. And so, hey, if anybody's listening to this and you guys think the volume is low on it, let me know. We've been doing this for like 2 or 3 years, and if I've missed something, or maybe it just was maybe one episode or something, but I came across that and I was like, huh. I mean, I'm pretty deaf, so I usually turn up it pretty loud. But all that aside, we're recording this on Friday. Jerry's headed out of town for the weekend, and it is the Marine Corps birthday. Yep. So I want to make sure that I
Happy birthday to the Marines. Yeah.
Yeah, Semper Fi, hoorah.
Hoorah is
the right version.
Yeah.
We got the hua. And, of course, you know, Sunday when this comes out, we will have passed Veterans Day. So happy Veterans Day to all the veterans out there. I got a couple of old veterans here, and we've got a couple of young veterans as our kids. So we are very appreciative of all the veterans. And so with that, let's talk about the crazy crap going on this week in the market.
Yeah. I mean, this week was a lot slower than last week. We had this crazy rally out of a bottom last week. And then this week, the market's a little bit higher, but it's looking like it's starting to peter out and roll over. And that's really the kind of what we're gonna talk about is a lot of Elliott Waves and Fibonacci retracements, and those are two tools that you can use to kind of figure out the direction of the trend. Like we always talk about the trend, right? And the trend is multiple time frames. So, you know, since the bottom in 2009, the trend is up, and but during 2022, the trend during that time period was down. In 2023, since October 2022, the trend has been up, but then since the top in July, the trend has been down. So depending on the time frame you're looking at, and how you're going to make reallocation decisions. And then Elliott Waves come in really, really well because they move in impulsive and corrective waves, right? So you got 5 waves up or down, whichever way the primary direction is going. You get 5 waves in that direction. And then you have a 3-wave counter trend that kind of takes the froth out of the movement of that, and it sets it up for the next leg higher, right? So that's how you get higher highs and higher lows, or vice versa. So if you can keep the time frames consistent with how your investing strategy, you don't get freaked out if, you know, the market dips or it gets higher. Or, you know, you need to keep it in context with the trend that you're actually trying to follow.
Yeah, and I mean, I think, you know, we say this a lot, but it's really important for folks to understand how it's not just the time frame. The time frame is all about perspective of, like, you know, like Jerry just explained, right? So what time frame you're looking at depends on how the performance of the market looks or which direction the market is going. And so you take a week like last week example. I think we ended up with, correct me if I'm wrong, I know you will, 8 green days in a row or something like that.
Oh, we're up to like 10 or 11 now.
Yeah. I mean, so
I don't think it's ever happened before. To be honest.
It's never happened, which is a good point.
Yeah.
It's never happened. It's not something you could guess. It's not something you could forecast. Go and look at any analyst talking about the S&P 500 right now, and they'll say that. They'll be like, nobody could have seen this coming. Yeah. And what they'll do normally, one of these analysts, they'll all of a sudden pull back a little bit and go, let's look at what's really happening. So yeah, we had this green week, which everybody, if you're in, you're happy. If you're out, you're pissed. Yeah. But keep reminding yourself that what we're talking about is a retirement account that has a lot of restrictions on it, right? You got 2 moves a month. You got to get the move in, but there is no way you can play something like this last week that you could. Now you can. You're going to be gambling. They call it speculation for a reason. Right? Yeah. We're not trying to gamble. Like, we're trying to see the trend, which I think is what you're getting ready to show. Right?
Yeah, I mean, I'm actually going to talk about it, I think, on the newsletter this weekend. But in I don't know how many, a couple of alert analyses ago that we did. And if people that read it, they would remember, and you can see it. My primary Elliott Wave count for the C fund for the S&P 500, coming off that October low, was a bullish count, right? We came off the October low, we had an ABC correction, and then we went up for quite a bit, and then we had another ABC correction. It came down to the right above the 200-day moving average line. It was it was like the end of September. It was the perfect place for the market to start moving higher, going into the seasonality, third year of the presidential cycle and all that. There was all these reasons from a Elliott Wave count perspective and seasonality that the market should have rallied there. And it did for a couple of days, and then it rolled over and put in new lows. And so what ends up happening in terms of the Elliott Wave of the chart is that the ABC correction failed, and when you got a new low, now that just turned into what? A 1, 2, 3, 4, 5 down. That's an impulse move to the downside, okay? So the beauty of Elliott Waves, whether you look at it this way or not, is that if the thing that you expect to happen at these transition points happens, great. If it doesn't happen, it tells you something also. And so, I'm going to get into the details of that in the newsletter, because it's technical and it's day to day and all that. But we'll show kind of in general how to do it here with this. So this week's event. So not a really big news week, like last week kind of was, but two big things happened this week, and I'm really curious to see how it plays out actually today. They had, let's see, the Fed announcement. Was that even this week? I can't even remember.
Yeah.
The Fed no, that was last week. That generated the rally. So the Fed comes out and says that, like he always says, we're going to keep rates higher for longer and all that. And we talked about it. The guys on Bloomberg were like, I don't understand how this rally is happening because the Fed was hawkish. This week, the Fed is Powell is at the IMF annual conference, and he's very hawkish, right? He's like, he's talking to Rogoff, the guy that wrote one of the best books ever about the coming calamity, into which everybody sort of agrees it's happening in the world of finance. But it's at this IMF conference in D.C. You got the central bank president from Israel, a bunch of others. So they're talking about what's happening in the world in terms of interest rates and inflation and all that. And Powell's very hawkish, and they're all agreeing that rates have to go higher because inflation around the world is a big problem. And so you also have the Treasury that comes out and does a third-year auction of Treasury bills. After the big rally last week came on the decline in yield and the decline in the dollar, right? But then the Treasury actually tries to sell some Treasury bills, and they can't sell them anywhere near the price of yield that came out the previous week.
Yeah.
So that's why you're seeing in the F fund and in I was listening to it today on Bloomberg. They're like, oh no, this volatility isn't going anywhere, because the market is not in line with the market saying we're not paying. You know what I mean? We want much higher yield to buy your bonds. And the Fed is like, I can't keep pushing rates up because we're going to bankrupt my country. Right. So there's a lot of stuff going on there, and you're seeing it in the play out. We had a huge pop in the F fund, and then VLGSX, the mutual fund. I've been talking about that forever. So in the short term, you're like, what should I do? Mm-hmm. Like, how do I possibly deal with this? Right. In the long term, we've had 3 consecutive years of down movements in the F fund and bonds in general. So in the big scheme of things, now is going to be a good this time frame. Right. The Elliott Wave count is down. We're at a 5. Whether or not it's completed or not, who knows, right? Can it go a little bit lower? Sure. Jamie Dimon thinks rates are going to go to 6 or 7%. Fed funds rate, that puts interest rates up at like 10 or 12%.
I
right?
know.
So the short term, no, don't know. Does the Elliott Wave count support a bottom right now in the F fund? Yeah, absolutely. And if it fails, it failed. But what else can you do?
Yeah.
Right. This is the structure of the way the wave pattern works. When it completes at the place that you thought it was going to complete and it made sense, great, you get in at the bottom. If it fails and you had bought it, you need to figure out a place where you say, okay, it failed,
Right.
and I'm getting out now. Yeah.
Well, we always talk about that, plan A, plan B.
Yeah.
You have to know what the next move is. It's check. It's not checkers, it's chess.
Yeah.
And so you have to think a few moves ahead. And sometimes that gets difficult, especially when you're first learning how to do this stuff. But I think buried in a lot of what Jerry just said, though, is, if you take a step back and try to think of like all the crazy stuff that's going on that hasn't ever happened or shouldn't happen, all that stuff, the real takeaway is we watch that stuff because it's our job. That's what we do, right? But the average person out there just trying to manage their retirement account, you really can't get too down in the weeds with all this. It's nice to understand it and learn it, but what you have to be able to do is take it into context and go, yeah, but what can I really do about it? Right? Day to day, what can I really do about it? Very little, right?
Oh, yeah.
Very little, but you could, right? Jerry mentioned the mutual fund window. If you've got some of your cash in there and you see an opportunity to kind of take advantage of this little bump with the I always forget the V. It's too many
VLGSX.
too many consonants for me.
Yeah. VLGSX.
But you have that, anyway, so are there opportunities to take advantage of it? Maybe. But the real takeaway is, stay involved, stay educated, keep learning about all this stuff, but put it into context of what you can actually accomplish with it, right? How much can you actually move your money around, inside the TSP or outside the TSP to actually take advantage of it? It's definitely good to be in the know. But you got to put it all in perspective. We always keep using that word, and I hope it doesn't get to be cliche.
Yeah.
But it is all about perspective. If you take a
is.
look at it and you go, because when we're thinking about this stuff, we're looking at the market as a whole and how it's impacting everything, and then we kind of drill down. How does that impact the TSP for you guys and us? And then it's like, okay, but I can only do so much in my TSP, or my IRA. Right. Yeah. We always talk about IRAs as kind of a one-off of if you have a brokerage account or an IRA, you might be able to take a little bit better advantage of some of this stuff we talk about. But even then you might not be able to, because as we've learned the hard way, just because you can move your stuff doesn't mean it moves that fast. Right? You can't day trade in an IRA. It doesn't work that way. You can in a brokerage account, but you can't barely weekly trade in an IRA. So it's not, it's still not completely with the gloves off, right?
Yeah. I mean, the tricky part about this stuff is, given you only have 2 moves a month and you have to have the noon rule, you're trading by noon to get that day's closing price. The weekly charts are the way to follow the overall trend. But you have to make a decision on a day. Right? And so that's where it gets very
complicated,
tricky, right?
Yeah. Because if you do it a day before some anomaly happens, down or up, doesn't matter which, right? But if you do it on a day, this is where you drew your line in the sand. You're looking at it weekly, but you got to make a decision on a day. And so the day you do it, something happens the next day that goes completely against what you thought.
Or that afternoon.
That afternoon,
right.
Even worse, right? Yeah. Even after that noon, when you got it in at 11 a.m., the world changed.
Yeah, and it happens at 2 o'clock a lot of times.
You just have to accept that that's the decision you made, and you're going to figure out what's my next move. Right. You can't dwell on the fact that, oh man, I missed 3 green days. Okay, yeah, kind of sucks, but there was nothing that told you that. So you didn't make a bad decision. The market just went a different way.
Right.
And it's very hard for people to accept that.
Right.
Very hard, because it's emotional, right?
Yes, that's why I don't know how you do any of this without looking at charts. I just can't. Otherwise, you're just talking to your friends, or you're looking at the screen on Bloomberg going.
Well, unfortunately, most people do, right? Yeah. We know that most retail investors invest on emotion. Yeah. They don't invest on data. And the ones that start to learn how to do it based on data tend to still let fear of missing out drive their decisions. Yeah. And so that it goes back emotional. The more you can take emotion out of your investing, the better you're going to be. It's very easy to say, very hard to do. Yep. So we all are challenged with it. I get challenged with it daily, but you just have to, first of all, you got to trust your plan.
Yep.
You got to have a plan.
You have a plan.
Right. You got to have a plan. And we think hope is not a plan, right?
I mean, honestly, it's the biggest plan, right? Because
looking at my little sticker, hope is not a good plan.
I mean, you can, there's basically you're a passive TSP investor or you're an active investor. And if you're passive, you're in one of the L funds or some combination of the stock funds, and you accept the ups and downs. Or you want to do some kind of active management of your TSP. And there are a good handful of ways that you can actively manage, but the two buckets are basically that. Hopefully the active management way that you looked at it either makes you sleep better at night, or actually outperforms the passive model.
Yeah.
So anyway,
over a long period of time.
Over time. Yeah.
Not within a given week.
No. I mean, honestly, the top in January 2022, the C fund's down like 15% or something relative to that top. So, yeah, we had big gains relative to the bottom. In 2023 we've had big gains, but if you step back just a little bit, you're like, well, I'm not ahead of where I was if I was buy and hold. If I was a passive investor, I'm not. A year has gone by and I'm not back up to where I was before. So that's not great. If you were using some kind of active model, would you have outperformed buy and hold over that one time frame? And then you go back more time frames and take a look at it. It just either you're in a buy and hold camp philosophically, or you're in an active management camp philosophically. And if you are in an active management camp philosophically, Elliott Waves is a big part of it. So pattern recognition, Elliott Waves, and Fibonacci retracements. So try not to let your eyes roll in the back of your head, because this is actually kind of interesting, I think. This is a chart of the regional bank index. All right. People are worried about regional banks because if you remember back in March, we had this crisis, and Fed had to step in and save the regional banks. Regional banks are the ones that lend to like local commercial real estate. So if you're looking at this chart, the index goes back to like 2006. This is the beginning of the index. It looks like, how could you possibly figure out? It's very squiggly. Yeah, the trend, in general is going up, but you got a lot of volatility, big moves going, all over the place. How are you supposed to possibly figure that out? If you put an Elliott Wave numbering system on there, it starts to make it possible to see the sort of shorter directions on this thing. So you have a 1, A, B, C for a 2. Okay, so the moves in the primary direction happen in 5 waves. So 1, A, B, C is the correction, is 2. 3, A, B, C for 4. And then a 1, 2, 3, 4, 5, which gives you the 3, right? Then we have a big move down for 4, which corrects this whole thing. And a 1, 2, 3, 4, 5 for a top there that gives you a bigger 1. So if you're trading this, if you're looking at it to invest in, if it's up here when you're looking at it, and you're like, well, it's gone up, so it's going to keep going up. If you're even just familiar with Elliott Waves, and you look at it and you go, okay, we had a big move off the bottom. Then we have an ABC correction. This is the best place to get in. Somewhere in here, actually up here. When it gets above these highs, you've confirmed that the next move is actually going up. So it gives you some structure. So if you're thinking about getting into it up here, you might say, well, I have this 5-wave move. Let me see what's going to happen next, because a move up from here doesn't fit in this count. Okay, so you get an ABC correction, which corrected this whole move up. When you get down to somewhere at the prior 4, right? So price got a little bit lower than that. The prior 4 is a guideline. When you get down here somewhere, after an ABC correction, you're getting close to the bottom. Might not be there yet, but you're definitely getting close to the bottom. In this case, it came down a little bit further, and then we had an impulsive move, 1, 2, 3, 4, 5, to a top. So if you were down in here somewhere, this was a good place to buy it, right? And you could connect the trend lines from the bottoms, and you could trend line analysis or Elliott Waves or whatever, but hopefully that gives you guys an idea. You get up here for a 1 again, you get an ABC correction. Okay, so this is where we are right now. So if this count is correct, we just did this ABC correction. If this is the bottom of the 2 wave, then 1, 2, 3, 4, 5 is what you would expect to happen, right? If you get 1, 2, and then it comes up, but then rolls over, okay? It means that this is a 1, 2, 3, 4, 5. Okay, so they're predictive until they fail. So if we got below this 2, then it's not a 1, 2, 3, 4, 5.
It's just a different count.
The count changes, and so that's how you use it, kind of as rolling forward, to try to understand where you are in the big scheme of things. Okay. The other thing you can do is Fibonacci retracements. So this was the 1, right? We started down here at the bottom, and you do a Fibonacci retracement tool from a top that you think is a significant turning point, a top or a bottom, right? So in this case, a top. The retracement from the low to the high, the ABC came down a little bit above that 786 retracement level. Okay, so you had this move up, 78.6% of that move, it gave back in this ABC correction. Okay. This was a top from the low. We had an ABC correction from it, and it takes us again just above that 786 retracement level. Okay, so that is confirming. So you're looking at the prior 4 we just talked about. This is where you get down to the prior 4. That's kind of the area that you expect to see a bottom. But you also know that you're coming up on that 786 retracement level, and price comes down and finishes just above it. So the odds of it continuing down significantly from here are not great, right? This is a low risk entry point to get in anywhere in here, because you have this count. And in this case, it worked, right? It recovered at the same Fibonacci level from a different time frame. And we had a 1, 2, 3, 4, 5 move to the upside. And then the last one, where we are right now, this was the top. This was that recent low. And we came down and got a little bit below that 786 retracement level. But we did it on A, B, C. So there's no guarantees that this is going to work. But the setup is really good. And what you're looking to get in, you're trying to get in when the setup makes sense that it's likely to move higher from here than lower. Does that make sense?
I think it does, but I look at this a lot more.
Yeah, I'm trying to just kind of put it out as simplistically as possible, because number one, there are patterns that they fail. When the pattern fails, it tells you something. When the pattern works, you're getting in at a great place.
Yeah.
When it fails, you just get back out. And yes, you're going to take a little bit of a loss when that happens.
Right. But at least you can, when the pattern fails, all hasn't failed. It's just that the pattern was different than you thought it was.
Right.
And that's not a bad thing. That's just a thing. That's the difference, right?
Right.
It's not looking at any of these. Any of these sort of ways that you approach the market, you have to build yourself a system that's not built on, if this happens, I failed.
Oh, right, for sure.
But a lot of investors do that. A lot of new retail investors build a plan in their head that has failure in it, instead of like, oh, it just didn't happen the way I thought it was going to happen. and hopefully you're not doing it the way I think it's going to happen. Hopefully you've got a better plan than that, right? And if the plan doesn't play out like you planned it, that's okay. There should be a plan B, right? And as Jerry shows with the beauty, I think, of Fibonacci, and not so much the Elliott Wave. For me, there are a lot of little rules in Elliott Wave that it takes you a while to grasp the importance of one versus the other, right? Some are guidelines, some are rules, right? Yep. And getting your head wrapped around that took me a little while. I still have a problem with some of it. Fibonacci I like because you can literally just, now because of technology, you draw those lines, pull it all the way to the top, and you can see it. Like you can see, you don't even have to know why those numbers work. You don't need to understand the math.
No.
All you need to understand is there's a higher probability that when it hits some of those lines, it's going to do something. And if it doesn't do that, that tells you just as much.
Yeah.
I love Fibonacci. Like that was a good example for me. If you move it back one slide, I was kind of thinking of this when you were on that slide. And this is just kind of a learning point, right? This isn't saying that this is what I would do. If you were able to, and he's not able to because it's a slide, but if you were to pull those lines across farther to the right, imagine that if you're looking at this video. Pull the lines farther to the right. And let's say you got in down there at that bottom that he was circling. Let's say you looked at that and you said, this is a pretty low risk entry point,
Down here?
Yeah. And I might say to myself, I don't know where it's going from there, right? You have to ignore the rest of that line because you don't know where it's going, right? It's blank right now. Right. And so you say to yourself, okay, when would I absolutely get out, right? This is what I was thinking when I was looking at it. Once it crossed that top line, I'd be out. The very top Fibonacci line.
This line.
Yeah. Right? Why? Just because to me, now I don't know what's happening, right? I mean, it's not that simple. I know that.
Yeah.
But I look at that and go, that would be a very now the question comes in, okay, what if it doesn't make it to that line? Well, you'd have to have a couple other little, what I'm saying is like kind of leading, go ahead and making your decisions before they happen.
Yep.
So when you're going to get out, right? Not to say that's exactly when you should get out. I'm just trying to use that as a kind of a teaching point. Yeah. If I got in down there, when's my next move if it climbs all the way up there? I'm getting out after it passes that line because I don't know where it's going from there.
Right.
And so because I don't know.
Yeah, 100%. That's a way to do it.
Yeah.
While you're talking, the one other thing I wanted to point out on this, let's say you saw that this was a 5 move, 1, 2, 3, 4, 5 to the top. Then you saw this ABC correction to the 786 retracement level. And you said, okay, those two things make my bias that the market's going to go higher from here, and it should go higher in a 5-wave impulse move because we just came off of this ABC correction to the downside. So we get this big move in a couple of days, right? And then a big pullback. Now I didn't draw the Fibonacci retracement from this high to that low, but you can see if you look at it, it's probably pretty close to that 786 retracement, right? But the idea is that you got a big move to the upside, a pullback, and then it started going higher again, and then gapped up. It is definitely going higher from there, okay? And so that's the same thing as where we are now. We put in a bottom from an ABC. We did a big rally to the upside, pulled back pretty close to, again, that 786 level, and it took off. It's not 100%, but it's like riding a bike. You start seeing these patterns.
It's better than guessing.
Yeah.
I mean that's how I look at it. None of these are 100% solution, but it's better than guessing. What else? My question always when I talk to people about this is, well, what else would you do? Like, if you have another way of figuring your plan out, then do that. But if you don't have any way at all, some of the ways we're showing you here are pretty useful because at least it gives you some left and right limits, some plan A's, plan B's. Because if you don't have any of that stuff, man, don't get into this game.
Yeah,
just stay passive.
Just stay passive. Yeah. Okay, so here's a chart of the S fund. Okay, so we're not going to do Elliott Waves on this, but we're going to do like pattern recognition. Okay. So we have a big rally in the S fund. We're back here from 2016. We get a big rally in the S fund that is, in this really good channel to the upside. Okay. Then we get an ABC correction. Okay, once we get a bottom in here, that's good because we know we should get a move to the upside after this ABC correction that corrected from this whole thing. And we do, right? We get a move to the upside. But what does that move to the upside look like? It looks like an ABC, right? Now, you don't know that until it failed. But in hindsight, you get this gap down, especially after this week. Obviously, this then became an ABC correction, and you get that big move down into COVID. Okay. So one of the interesting parts about this is you have this leg up and this leg up are basically the same distance. If you did distance here and distance here, it's basically the same. So you have this ABC setup, and then the market rolls over. So generally what happens is you get a move in a direction, a consolidation or whatever, a move in the next direction at the same distance, and then either it's going to keep going, and then you have a 1, 2, 3 that you're in, or it's an ABC and it rolls over, and you don't know it until you get to that point. So the reason I'm kind of pointing this out is this is a bullish consolidation pattern. And we get a move to the upside from it. It's bullish because the primary trend going into it was to the upside. So you have this ABC correction, you get a move to the upside, you have some consolidation. Because the last move was up, you expect the next move to be up, which it is. In terms of the S fund, currently, we've got this big down move. And this sideways consolidation looks an awful lot like that sideways consolidation. It's just in the other direction. So where this is a bullish consolidation because it's coming off of a run to the upside, this is a bearish consolidation because we have a run to the downside. And so you're looking for this length to be the same as this.
Which is a bit scary if you're in the S fund.
It's very scary. Now, it doesn't mean it's going to happen.
Right. Yeah.
Right?
That's the hardest part to wrap your head around.
Right.
Is because, no, wait a minute. That means that's what's going to happen. No, there's a high probability that that's going to happen.
Right.
But it can't be 100%.
It can't be 100%. And so if we drill into a little bit more, you basically have, this didn't quite get to that high, but you have essentially a flat at the top, and you have this triangle connecting these lows at the bottom. And we broke through there. And if, for those of you that read the alert analysis, when we broke through there, we got out of the S fund because this breakdown indicates that we're going lower from there. It doesn't mean it's 100%. And the very next week, we had a big up move. Now, it didn't take us back. We're still out of the channel. So the expectation of this is still there. But this was a big swing. It was like, 7 or 8% swing. And so if you don't have this perspective that we keep talking about, why perspective is so important, if you look at just this week where the S fund's up 8%, and you're like, this is crazy that I wasn't in the S fund to get those gains.
Right.
If you step back a little bit and say, yeah, but
Yeah, but the probability is that it's going down, and you can't get caught how many moves you got left. You can always get out, right?
Yep.
You can always get out. But if you're getting in for that, it feels like you're getting in on a whim, right?
There's nothing in this chart that
says get
in the S fund.
Exactly.
Yeah.
And I guess that's the takeaway. And it's hard for us because we were just talking about this before we got on the podcast, how, we try to do a balance between digging into the weeds and the charts and doing all of that, and then, trying to bring it back up a few levels for like folks that are just trying to figure this out, right? Yeah. And it's hard because at the end of the day, you have to learn this stuff or it doesn't work. And it takes a while to learn it, right? Yeah. So, what do I do in the meantime? You do the best you can. Like that's really what it comes down to. And you watch podcasts like this, or you read newsletters. You do all those things so that you can hopefully speed up the process and that you can help make better decisions. I think the struggle for a lot of folks right now, because of the kind of market we're in, we talk about this too all the time. We don't just talk about it. Everybody talks about it. Yeah. We're in a time right now that is very unlike anything we've seen in the last few decades,
Yep.
right? Because we've been in this 30-year run plus of like upward movement of the market if you just pulled back and looked at it. But you go back far enough, and that isn't the case. If you go back to the 70s, 60s, 50s, the world did not look like it does, or it has
over the past 30 years.
It has looked very different, and we don't know that because we weren't around or whatever. But the point is if there's any takeaway from all this is that there's patterns in this,
Yep.
and it's cyclical, and there's nothing. Everything is pointing towards the fact that we're heading to one of those really, really volatile times, and it could be dangerous. This isn't a sky's falling kind of thing. It's more of that. Where I'm going to is understanding the kind of investor you are, right? Understanding how much you really want to get into this, and knowing, all right, you know what, I'm better off being out with no anxiety.
Mm-hmm.
Now you got to have no anxiety when it's going up, right?
Right.
But you definitely aren't losing money.
Right.
Just because the market is going up. This is knock on thing, right? Listen for a second if you're watching this podcast. Just because the market is going up and you're in the G fund, you are not losing money.
Right. That's true.
You have to understand that. You're missing out on gains that you really wish you could have gotten, but you're not losing money.
Yeah.
And once you can wrap your head around that and go and be okay with it, right? I would much rather not lose money than try to chase gains that could end up making me lose a lot of money.
Yep.
Right? Anyway.
Yeah. It's very tricky. It really is. And you look at a chart like this, the S fund, which is, the C fund is the S&P 500. It's 500 largest companies in the U.S. The S fund is the other 4,500 companies in the U.S. And so it's a much better chart of what the actual economy is doing. And, we'll look at a C fund chart in a second, but obviously the S fund has not been performing very well. And that's the majority of the companies in the United States. All right, so that's pattern recognition. So we did Elliott Waves, basically Fibonacci retracements and pattern recognition, right? This is the inverse, but similar to this pattern here. So now everybody's favorite is the C fund, okay? So here we are back in the bottom in 2009. Every Elliott Wave analyst, everybody agrees. If you start back at the bottom of the Great Depression and you go up from the 30s to the bottom in 2009, that's the bottom of a 4-wave, okay? And so the bull market that we've had since 2009 is wave 5. So Elliott Wave International, and definitely the majority of Elliott Wave analysts, see this as the long-term count, okay? So that means this 5 is the top of a 5-wave structure that started at the bottom of the Great Depression. Not really helpful, honestly, in terms of managing your TSP, because all that is like, oh my God, the sky's falling, right? But let's say for the sake of the conversation that this is the top of the top of the top, right? This is going to be a long-term market top. We have 1, 2, 3, 4, 5. That's an impulse move to the downside. Okay? That's for a 1 or an A. Because it's a 1 if the structure is going to be 1, 2, 3, 4, 5. Okay? If we have some kind of, depression era type of thing. That's what that is. It's an A, B, C, if we're just going to pick up and this thing is going to keep on moving in a big scheme of things. Okay, and that's going to be the next chart. But if this is the correct count, we've got an impulse move to the downside. You got an A, B, C for a B, and a C. Right? So this is corrective. So the next move, which we are in right now, is to the downside. And again, if this is the top of the top of the top, this downside is going to be significant. And that's not inconsistent with all the macro stuff going on in the world and all that. But set that aside because you don't know that, and it's a completely different way of looking at the world. Okay. This is what most Elliott Wave analysts, how they see it. So if this is the top, then we have a 1 or an A, and this is a 2. And we are in some kind of downtrend for some amount of time. This is an alternate count. Okay. Same chart, but you get the same, you get to move higher, right? You got 1, 2, 3, 4, 5. You get an impulse move to the upside for a 1. You get an ABC for a 2 that corrects down to the prior 4. So everything is looking good. Now we're in the 3 wave. You got 1, 2, 3, ABC for 4, 1, ABC for 2, 3, 4, 5, which gives you this 3. You got an ABC for a 4, and you get a 5, which takes you right before COVID. If that's actually the top of the 5, then you had COVID, which brings you down to the level of the prior 4. Okay? Then this count, 1, 2, 3, 4, 5, is a new wave 1, right? This is corrective, and we're off into this 1, 2, 3, 4, 5. If that's your count, that's the bullish count, and it's valid. It's not great because this wave 4, if this wave 4 is much bigger in price and lower in time than this wave 2. Actually, this wave 2. So this wave 2, it's pretty small in terms of price relative to this wave 4. So,
but just taking that counter argument, right? You could make the you could take the position that the pandemic was an anomaly, mm-hmm. and it made that look different.
Good,
right?
Yep.
And if this was your count, I'm only kind of
yeah,
just trying to show how you could justify accepting that as the count, and it very well could be it, right? How do we know which one's correct?
Yeah, that's a good question. So here's how you know. If this is a 5, then this is a 1, 2, and we keep moving down, right? If this count is correct, then this 1, 2, the next move higher should be wave 3, which is explosive to the upside. Okay. So let me just go back. This is what everybody thinks is happening. We're at a high. This is a 1, 2, and we get a 3 to the downside. That's that count. This count is we just moved the 5 over to here. If that's the case, COVID is a 2, and this is a 1, 2, and we're in this wave 3 that keeps going higher. So how do you know which one's right? When this high gets taken out, that's how you know. If this wave keeps going and gets above this high, we are in a wave 3 to the upside. Now you got to give it a little bit of room, right? Can you get up here to 48.50 and we have a double top and it rolls over? Yes.
100%.
There's no guarantees in any of this, but
and you also have to accept that it could take a little longer than it looks here on this chart, meaning it could widen out a little bit and take a little bit longer to cross that, right? As opposed to getting this way and going faster, right?
Yeah.
Generally speaking, it would look very similar. So if that's the case, you still got a little bit of time before that might happen, and then you're waiting till it crosses. Is this a weekly chart?
Yes.
Yeah. So that's a lot of time to kind of let that play out.
Patience is a big part of this.
It's huge.
You look at the chart patterns, and you have to let it play out to the point where you've either confirmed the pattern, or the count becomes.
And if you're a long-term kind of less active, we're on the more active side. There's definitely a lesser active side where you would make less moves over time. And if you were looking at just this chart, that would tell you when you wanted to stay in or get out completely, right? Right now, you might be in right? Because depending on how you're looking at that count.
Sure.
And then if it hits that resistance level that Jerry's kind of drawing out there, and then rolls over and starts going down, and you would have every piece of information you need to say, I'm out for now.
Yep.
Until it comes back up and crosses back through that, there's no reason why you'd want to be in.
Right. The big what is the sort of line in the sand? Let's say
I don't have it on the chart. There you go.
So what's sort of the line in the sand that everybody is going to be looking at, which is how you get these kind of overshoots. But if we get below that October low, this 1-2, we get down here somewhere and it keeps going. We get below these lows, and the best case scenario is an A, B, C, which actually takes us down to about 3,200.
That's best case scenario.
Yeah, because that makes this length the same as this length, and then that's it's picking up the longer term trend line and the 200-week moving average line and some other things. That's the best case scenario.
If it crosses down through that, it keeps going. It's a bad day.
Yeah,
bad week, bad time.
And you don't want to be in it.
Yeah.
Then
why would you?
Yeah, and those are the kinds of losses. I mean, it's good to avoid these losses, but you don't want to be if this is a 1-2 and this 3 really gets going. You don't want to be in it, and you're going to know it when it gets below that low. And when by the time it gets down here, you're going to have people saying, "Oh, it's a double bottom." We've been in a bear market for 3 years now, and the market has to go higher from here. I mean, all the conversations are still going to be there.
But the moment it crashes through that line, you'd stop listening to all that.
All right. Yeah. Oh, so okay. I got one more chart. TSP fund. So if we zoom it in a little bit and just add a relative strength indicator. So a couple things. Now it's a weekly chart, but it's pulled in. Here's the bottom from COVID, and this is the relative strength indicator. So relative strength is a really good. It's a great indicator, especially on a weekly basis. When you get way oversold, you can stay oversold for a while, but you're buying it at a relatively low value level. It got oversold here probably on this week. It's kind of hard to see, but probably on that week. And so if you bought it on this week because that's when it got oversold, you'd have to let it ride down, and this would be painful to take those losses. You could let it come down and turn back up and buy it when it crossed that line. So you're probably buying it on that week. But relative strength is really valuable. In terms of the trend, once relative strength gets above that 50 line, which is generally when price gets above the 20-week moving average line, they tend to happen like at the same time. When RSI is above 50, you're in a bull market. Now, let me sort of, no. When RSI is above 50, every bull market that starts on a weekly basis happens when RSI gets above 50. And price has to be above the 20-week moving average line. Because if it's not above the moving average line, it's moving lower. If price is below the moving average line here, and the moving average starts turning down, it only happens because price is below that line. So if you're in a bull market, you get above that 50 line, and then every pullback finds support there, right, or higher. And then once you break down through that 50 line, again, it happens very close to when we get below the 20-week moving average line. When you're below the 50 line, right, is when you don't want to be in the stock funds, because this is what's happening. Okay? So what that means is, if we're down here after COVID, and we get above the 50 line, and I get in, and where price is above the 20-week, we're above the 50 line, and I get in to the stock funds, that's awesome. And we know going forward that good things happened, right? And we got support here at that 50, so let's say we didn't get knocked out at that retest of the 20-week moving average line. and we're in the stock funds and we're above 50 and everything's great. At some point we get below 50. I mean, that's a giant red flag on a weekly basis, right? It happens on this week. The tricky thing is that in a bear market, you have these overshoots. In general, you're below the 50 line. But these overshoots create like whipsaws. The overshoots are these little upticks. And it's very difficult. It's very frustrating when you get them, because you know that when it gets above the 50 line and it gets above the 20-week moving average line, that can be the beginning of a new rally, but it doesn't guarantee the beginning of a new rally. So if you're trying to get in as reasonably close to the bottom as you can, you're looking for some conditions to be met, like these two, but it doesn't guarantee, right? So that's where you have to have a plan A and a plan B. My plan A is that we got above the 20-day moving average, 20-week moving average line. We got above 50 RSI. My plan A is that the market keeps going higher. My plan B is that if it's wrong and it rolls back over and closes below the 50 line and below the 20-week moving average line, now I have to get out, right? You don't have to get out. You can do what you want, but that's what the analysis is telling you. So if you fast forward to where we are right now, we had a peak in RSI back in July. I guess it was here. Price comes down, got support for a week or two at that 20-week moving average line, and we're still above 50 on RSI, so we're good, right? Once price breaks below that 50 line, right there, you gotta be concerned about it, right? Because price is below the line, and RSI is below 50. And so what happened last week, the week before, whatever, the big move to the upside? That's that big move to the upside. We closed back above that 20-week moving average line. We did get above 50, and we're hitting, the orange is the moving average of the RSI. So we hit that line, and it looks like we're rolling over, right? Because this week is today's Friday, so we don't have a final for today. But it looks like it's going to come in as a down week, not by much, but a little bit of a down week. So the question is this just an overshoot of the 50 line and it goes back down, which means price goes down? Or is price going to break through that orange moving average line and keep moving higher? In that case, price moves higher. So those are the decision points that you have to make. If you think, for whatever reason, that price is going to keep moving higher, then get into the stock funds. If you think for whatever reason that price and RSI are going to roll over, then be in the G fund. If you let it play out for a minute, let RSI get above that line if it's going to do it, and let price get up above, so it did find support at that 20-week moving average line, and it broke that downtrend line. So if we can get price up here somewhere and RSI here somewhere, then it's likely that we keep moving higher, right? And then this 1, ABC for 2, 3. The problem again is this was the ABC that we were talking about earlier in the show. This is right where plan A would have been the market kept moving higher, but it didn't. We had 2 more down weeks. Okay, so now this, what should have been an ABC, becomes a 1, 2, 3, 4, 5 impulse move to the downside, which if this doesn't get above this high, we're going back down. So I know it gets, I end up in my own head talking to the chart, and people are probably like, all right, I've had enough of it. But that's where the if-thens come from. All right. If you guys want more like day-to-day detailed kind of in the weeds, it's definitely in the newsletters and the alert analysis. I mean, cannot stress enough, if you're a subscriber, to read the alert analysis. And if you have questions about what the analysis is and why we made the decisions that we made, please hit us up at support@growmytsp.com or put it in the comments of the newsletter or alert analysis, ideally, because that's the easiest for me to do that. All right.
If you guys have any general questions for us, you can shoot them to us at support@growmytsp. Put them in the comments section wherever you find the video, and we'll do our best to answer it. We got some good comments and stuff. I think it was last week on the YouTube video where we posted on YouTube.
Mm-hmm.
I haven't had any coffee this morning. Dadgummit. Anyway, if you have questions, shoot them to us. The best place to put it is wherever you find the video. If there's not a place there, shoot us an email at support@growmytsp, and the support team will get it over to us. We hope you guys got a lot out of this one, and we will see you next week.
Have a good weekend.
Bada bang.